Hello, everyone. Welcome again to another America Outdoors webinar. We're really happy to have you back for Pat Tabor 2, PPP Loan Forgiveness Strategies, Manager Outcome. We're hoping for another epic tale as we had last time. Actually, we've not discussed time limits amongst our own group, but certainly we do have some ability to be flexible. So I look forward to having some time with you, Pat, and I am handing it over to Hillary now to lay out the logistics and get us on our way.
Hey, everybody, good to see you. A few things that we're going to go through real quick before we get started. For those of you who joined yesterday, GoToWebinar was having some issues and we haven't been able to access the recording yet. So since you're already on here, I do just encourage you to take some really good notes. We're hoping that this will be recorded and that we can put it on the COVID-19 page, and that's the plan. But just in case, you know, kind of let's act like that's not the case, and everyone take good notes and ask your questions while you can. As for questions, we are using the question box. So if any of you are leery about how to use that, feel free to test it out right now. You can say hello. And Pat will be taking questions at the end, which I will read. And finally, if anyone's having trouble hearing or anything, it could be an internet issue, and I would just suggest that you try logging back in, or you can drop off of the internet version and call in on the phone. Pat, I'll go ahead and hand it over to you so we can get to it.
Thanks, guys, and I just want to give a shout out to both Hillary and Aaron. I think they've done a pretty phenomenal job having the industries back these last several trying months, and I just appreciate everything that you guys do. You probably don't get enough accolades for all the hard work you do, so I appreciate it. So similar to the last one, I'm going to try to fly through material to leave time for questions. But having said that, I do want to make sure that we cover these things. So if you are a person who has not filed a PPP, we'll have a little bit of information on that. But to be clear, really the thrust of this is oriented towards people that in fact have done the PPP, and now they're in the mode of trying to manage the forgiveness during the 8-week forgiveness period. So that'll be the primary focus of this. But I am going to do some updates on PPP, including the self-employer edition, as well as we got some great news on Monday as a result of a real team effort that there's very specific guidance now out of Treasury that allows a different measurement period for seasonal employers, and that's just huge. Too bad that didn't come out 6 weeks ago. We could have really used it because some of us had to leave money on the table based on the old way of doing it. So we'll talk about the forgiveness process and how to try to maximize that, and then we'll go through a few tools, give a quick update on EIDL, and then we'll wrap up. So let's jump in. As you know, it refunded and the gates opened on Monday, and there was already I heard a 42,000 application backlog that was sitting in the queue that stopped. So add to that all the new loans that are being requested this week. It will run out of funding. The latest I heard is that it's going to probably run out by next Wednesday, but you never know how accurate that is. So this is going to be the last one. I don't think they're going to do a round 3 for PPP. They'll probably come up with something different. The other thing is they're trying to get it refunded by going back and auditing all requests over 2 million. So if somebody got a loan more than 2 million, SBA is looking at it, looking very closely as to who requested it and whether it really qualifies with the spirit of what was in the CARES Act. As I indicated, the PPP guidance for self-employed is out, and I forwarded that document to AO. I believe it's on the COVID-19 site portion of AO's website, so you can look that up. And then the seasonal measurement is just in as a result of the conversation. It's kind of very satisfying because a lot of people helped on this. But at the end of the day, when I looked at the actual language in the Treasury guidance, it was cut and paste from an email that I had sent to Dane's staff in terms of this was what it needs to look like. So they just ran with it. And, you know, the really cool thing about that is if you have not applied yet, you can take the best 12-week period in the last 12 months and use that as the basis for your, I wish that was around when I did it, because we have a really crazy peak period for July, August, and September. And if I could have used that instead of the 12-month averaging, I probably would have eked another 50 or 100K out of the loan balance. Now, I heard just yesterday from a regional SBA person that they will absolutely allow you to resubmit an application, but it requires a really funky process. You have to pay off the existing PPP that you have and then go back in and reapply under the new methodology. And of course, the risk associated with that is if you don't get in on the round, then you could get majorly screwed on that deal, because the next thing you know, you've paid off the proceeds from the old loan, you didn't get a new loan, and you're out of PPP altogether. So, I mean, I think you have to really scratch your head. I know some people, when they did the seasonal calculations that were afforded to them, they got a measly 10 or 15 or 20 grand, which didn't amount to much help at all given their seasonal volume. For somebody like that, it might be worth it. But for somebody who's, you know, got a couple $100,000 and this would represent maybe an extra 50 or 100 grand, I just can't in good conscience recommend doing that. It's too big of a risk for you. So there's also no additional guidance as of yet on forgiveness. And so we're working on the best assumptions to date. And I have to emphasize that this is subject to change. If you learned anything about PPP, you realize that stay tuned, you'll always see something different in the days to come. So what is forgiveness other than what our world needs right now? Right now, if you look at the CARES Act, it's just ridiculously fraught with inconsistencies and contradictions throughout the law, which means that accountants and lawyers and everyone else are interpreting using their best guess and linking it to IRS code and all sorts of other definitions throughout law to try to assume that they understand what was meant, or they look to the intent of the law. So like the application process, at the end of the day, it's going to depend on your lender. That is the biggest key element, because I have been hearing about some lenders that are remarkably generous and then other lenders that are just, you know, real stick in the mud. So it depends on what lender and the regional office of SBA that they're interfacing with. So you should just know that the info in this webinar is based on interpretation of the law's intent, and there's really no guarantees. Just like I had shed some light on some really cool tactics last time when you're doing your application, it was really neat to hear that several people did it and it worked. And then I got other people calling me back and saying, hey, that didn't work, why not? And it gets back to this issue of your lender and the regional office they're with. And then finally, documentation and backup is going to be critical in this forgiveness process because you may have to defend your ask. So plan from the start what you're going to do in terms of your documentation. It is highly recommended, if you can, to set up a separate checking account just for your PPP proceeds. You're going to want canceled checks and all reports, schedules, and other documents. So let's get into the specifics of what's happened, and I'll revisit that documentation thing in just a little bit. So first of all, I think you all know that you have to use the loan proceeds for payroll costs. You can use it for mortgage, interest, rent, utilities, payments over the 8-week period covered after receiving the loan. So it's important to note that the final rule provides that there's no more than 25% of the loan forgiveness can be attributable to non-payroll costs. And you're going to see when I finally get to an example that you will actually get penalized if you use your proceeds for in excess of 25%. It will come off your forgiveness dollar for dollar. The next thing you have to understand is there's a series of tiers of tests that all reflect on a lower percentage of of forgiveness. So the more that you qualify for these tiers or tests, the more tainting or subtraction of your forgiveness will occur. So the kind of the high level altitude one was the 75-25, 75 for payroll, 25 for non-payroll. Then what will happen is if you have decreased your FTE employee headcount, and that is an average FTE, not a high water FTE, and that's important because if your average FTE is lower than your high water FTE, that could be problematic for you. It's determined by dividing the average FTE employees headcount during the 8-week period and then comparing that to one of two periods, either February 15th, 2019 to June 30th, 2019, or effectively what is the previous payroll quarter, which is January 1st, 20 to February 19th, 20. So those are the two tiers there. The third tier is this odd measurement of wage balance. So if your wage balance is more than 25% on a per individual basis, you actually literally have to set up a spreadsheet if you think you run the risk of this. So where this applies is if you are the type of employer that brought your people back, but you brought them back under substantially reduced wages. So you want to keep everybody, but you've all made them take a pay cut. If they're effectively being cut more than 25%, that will once again have a dollar for dollar impact on how much will not be forgiven. And then the final issue is relative to if you have not restored your FTE employee headcount and salary and wage levels between February 15th and 20th and April 26th of, I'm sorry, February 15th to April 26th. If you haven't restored it to that level or higher, that's another taint. So this is so remarkably confusing, and you'll see later that what I've done is I've tried to interpret all this. You can't imagine the different documents and interpretations that I've studied, and kind of boiled it down to a formulaic approach, and I'll share that with you in a little bit. So a couple other specifics. The 8-week period covers the loan origination date, and then you have 90 days to submit your loan forgiveness documentation after the 8-week period ends. Then the lender has 60 days to make a decision on forgiveness. So for most of you, if you're ending right around between June 15th and June 30th, you essentially have 90 days to ask for your forgiveness and provide the documentation, and then they got to turn around and do the 60-day deal. So if you're deferring your employer portion of Social Security taxes under that CARE Act, some people are doing the employee tax retention tax credit, because that can be an advantageous tool if you are a larger employer and have several people on payroll still. You just need to be aware that there are no longer eligible to defer those taxes once you receive the decision on loan forgiveness. So that's an odd rule that came out, because what it implies is you can qualify for the utilization of that credit while you're still not subject to forgiveness. So if forgiveness gets granted in 90 days, that could be the entire operating season for some of you. So it may represent a double dip. I want to study it more, and I want to talk to more CPAs about it. But in theory, in that regard, you might qualify for the employee tax retention credit and therefore get forgiveness of FICA and some other things, and then turn around and stop doing that and get your loan forgiveness and carry it from there. I got to get clarification, so don't run to the bank and spend that money, because I'm not exactly sure how that's going to work. So FTEs, this is a confusing thing. It's not stated how to calculate an FTE. FTE is an acronym for full-time equivalent. So the consensus is the test is similar to the American CARE Act, where employees who work 30 hours or more will be considered full-time employees. So any person who holds a full-time position is one FTE. So a lot of people get confused between FTE and seasonal. You can be a seasonal employee, therefore only work 3 or 4 months a year, but when you're on more than 30 hours. So therefore you are an FTE, even though if you were measured on an annual basis, you wouldn't be close to an FTE. So we're going to go on the basis that the number of hours that you worked during the contact period defines whether you're an FTE or not. So part-time employees essentially work can be added up, and you can get to a fractionalized addition to your FTE count by taking all the hours and everybody else and then dividing by the number of employees, and you can get an additive for the people that are truly part-time, where maybe you're only working 10 or 20 hours a week. So here are the steps. Avoid reducing employee headcount during the 8-week period. That's the whole purpose of the law. So if you can, and I get it, believe me, I am suffering from this in ways you cannot even imagine. We're being jacked around by the National Park Service, by the Forest Service, by the state of Montana relative to, can you open, do you have to quarantine? So this ability to bring people on is not something that's being driven by us. It's being driven by all the rules we have to comply with. But at the end of the day, if you can restore your FTE count back during the 8-week period to a mark that's higher than what you put on the face of your PPP application, boom, you're done. The next step is you got to make sure that you spend 75% of those proceeds or more on, and I put in quotes, payroll expenses, and no more than 25% for non-payroll. Now remember, for every dollar you spend on that loan, you're going to get in trouble if you don't wind up doing it in just that exact way. So choose the option of counting the average full-time equivalence that results in the lowest number as the base number, and then ensure you have more than that during that 8-week period. Avoid reducing compensation during the 8-week period by more than 25% of what you paid to any one employee in the preceding quarter. So I've kind of summarized this in these charts, and it summarizes it really well. We're going to have this posted, this presentation. Hillary will grab it and post it immediately, so you'll have the benefit of all this detail. I am not going to go through this because I just did essentially, but these next 4 slides really nicely spell out how it works in each of those 4 tests that you had to achieve. And between that and the tool that I'm going to introduce to you, you should be in good shape to be able to calculate it for yourself. So with that, I do want to show you this example. And I apologize, it's perhaps hard for you. Aaron tested this and he said on his screen he could expand the view. If I do that on my screen, then it turns into multiple screens and it's really hard to read. So you'd put your company. Yeah,
I have like a
go
little
ahead,
toggle, and I can just push it all the way up and then go full screen with your screen. Yeah. Hopefully everybody
cool.
can. Yeah.
And you're going to get this tool immediately as well. So, you know, I'm just going to step you through it. So you'd put your name of your company here. The reason that I'm providing this to you is this absolutely can be your lead document that you provide to your lender. I've already vetted this with about 15 banks. I've had them review it and they say, yeah, if I had a borrower that provided me this, that would be golden. Now, of course, you might have a bank that says, what is that crap? But, you know, I think this is a pretty good summarization of how it works. So I just want to emphasize this thing on line 4 and 5. It's based on my company's understanding of the CARES Act up to today, and is subject to change as additional guidance is issued. And it's your obligation to pay attention to that. If different guidance comes out, it may alter this. So the way I built this spreadsheet is everything that's in yellow represents a variable that should be completed with your data. And when I first designed this, I thought, you know, I'm going to leave the application portion of it out because we've already covered that in some of the other tools I provided to you. And then I realized it's probably best to have it in here because you can see how the original application and what you were awarded, how it ties into the forgiveness part. So here are my assumptions here. This company had $1.2 million in wages, and I will tell you that that probably did include some tips, and it probably did include some other creative areas like I discussed in my previous presentation. It also included state, excuse me, I take that back. So those are the salaries plus tips, wages, and remember, you have that caveat that you can't include wages in excess of $100,000 for any one individual. You get to include your group health insurance, you get to include your retirement benefit cost, and then your state and local taxes on employee compensation. And see this right here, WC? Everybody know what that WC stands for? Work comp. So 3/4 of the people I've talked to put work comp in there and it went through. And I'm still not hearing that it will not be accepted, but subject to change. So you take all those things, it comes up with an average monthly total. You get 2.5 times, and so here starts to become the forgiveness calculations. This participant had got a loan, a PPP loan for $290,000, and so threshold 1 is 75% has to be used for payroll. So that's 217.5, and the rest can be used for non-payroll items. So allowable uses is defined above are these things. This is right out of the law, and we'll cover some of the details in that a little bit later. We've gotten some additional guidance. I just learned during this week that rent does not have to be just real estate rent. And so, for instance, we're a large horseback operator. I think you guys know that. We pay a massive monthly pasture rent to a hay grower who lets us winter our horses on his land. And I've got unequivocal approval that that monthly rental can go into this calculation, and that's pretty huge for us. Equipment rental. Remember, there's one really important test. Anything that you list in here as an expense has to be based on an agreement that was in place prior to February 15th, 2020. So by way of example, we went to the American Outdoors Confluence, which most of you hopefully did. And you guys might recall that there was a booth there that was talking about all sorts of sophisticated communication. So my daughter signed us up for a VoIP program, and it's working superbly well. I'm here to tell you. But we signed up, and the first application of it was, I think it became effective on March 1st. All our payments associated with that telephone system that would fall under utilities, we don't get to include. Why? Because the contract wasn't in place prior to February 15th, 2020. So now let's see how the loan forgiveness actually works. So right here, these are actual computations. So salaries and wages, here are your pay periods. And here's something really unique. I could actually add a pay period here. I just learned this yesterday. So our particular company pays from the 1st to the 15th. That's one pay period. So we pay that on the 20th of the month. And then we measure the 16th through the end of the month, whether that's the 30th or 31st, and we pay that on the 5th of the following month. So we've had a pay period that straddled our loan, our receipt of our loan. It was April 1st through the 15th, and it got paid on the April 20th. Because it got paid on April 20th, and because the law indicates that it's based on cash payments, even though the period of payroll fell prior to when I received our PPP proceeds, which happened to occur on April 16th, I get to count that payroll that was April 1st to the 15th paid on the 20th because the payment fell within that 8-week period. Now, this is the key period for us, the pay period ending 6/15. Ordinarily, we would pay that on 6/20, But if I pay it on 6/20, I won't get the benefit of it. And that's going to be our largest one because that's when we're going to have all the employees back, hopefully, if we get to open. So what we've already worked out as an arrangement with our accountant is we are going to go ahead and both accrue through and pay on the 15th. So we have to do some little extra work. The employees are actually going to get paid 5 days earlier than they ordinarily get paid, which is perfectly fine because that way we will have paid it within the 8-week period and that payroll will qualify, which we really need. So you can see here that I summed up salary, wages, commission, and vacation pay. We took our healthcare premiums. We were in arrears because we were getting a break from the provider. We're going to pay up all of what's in arrears and pay that amount. We're going to prepay our typically we wouldn't pay these retirement benefits till the end of the year. There's nothing that precludes us from paying them now. So we're going to pay them in this period. And then finally, you have the SUTA. And see these small amounts here? In the state of Montana, the SUTA is only, I think it's 0.015% of payroll. That's why these amounts are so small. So you ask yourself, what is this? Well, that's our quarterly premium for work comp. And I'm throwing that in there. You can see it right there, plus the SUTA of 18 bucks. I'm running that through. Now, what happens? I'm going to start playing with this, but what happens if this comes down to 5,000? What'll happen is that drops that amount. Now we fall under our threshold and we're going to get tainted, and you'll see these taints occur all the time. And that's why I wanted to do this. You have to pay attention to how much your payroll is adding up to be, because it's got to hit that magical 75% mark. Now we'll go on to the next one, the non-payroll cost, rent, now utilities. I've had it verified today, or this morning earlier, but then yesterday, some pretty breakthrough things on utilities. If you're really struggling to get to this number, the 25%, like you're just really having trouble getting to that. Most people have no problem at all. They have more expenses in here that they care to remember. But if you are having trouble, remarkably, there's a ruling out there that says that transportation costs during the 8-week period could qualify. These would be legitimate business fuel expenses that somehow or another is being interpreted as utility and could be included in this. So if you're one of these rare people that are having trouble getting to your 25%, and in particular, you just don't have enough on either interest or in rent, just email me directly and I'll work with you, because that's a pretty rare instance. So here's the tentative forgivable expense calculation here. And anytime you have non-payroll expenses, so watch what happens here. What if I make this $5,000? It automatically tells me that $4,000 is not going to be forgiven. Why? Because I violated that most important principle. You cannot have more than 25% for non-payroll costs. So that $4,000 is not going to get forgiven. So as long as you hit the 75-25, you're cool. Now we'll go down to these crazy, stupid, tiered deals. You'll see that the monthly average full-time equivalence is on the loan itself. This you take directly off the face of your PPP application. Whatever you put there on your application is what you put here. And then here's the two measurements. Either your FTE in June 15th to June 30th of 19, or your FTE of January 1st for February 29th. I'd suspect if most of you guys are like us, our lowest employee count is in that first quarter of January, because that's the lowest part of our season. Now, for some of you that are winter operators, that may not be true, but for the vast majority of people, this is going to be their lower number. If in our case it was lower than our average FTE for that period of February 15th through June 30th. So watch what happens. What if I just put 19 in here? It automatically switched. So it takes the lower of the two. That's how the law is written, is you get to take the lower of the two. And as long as, now if for some reason this was 8, see how much taint occurs? Holy smokes. So we're getting a 42.86% reduction because we were not able to, I take that back. No, that's right. For some reason that doesn't seem to make sense to me, but you got to play with it a little bit. So each of you should try to figure out which one works for you. And then the final one, this is just a dollar amount. So if for some reason you paid somebody or you reduced their pay by more than 25%, so let's just say one person I reduced by $10,000, then it's going to reduce it by that amount. So any one of these things will have the impact of reducing your loan. And if you did get that $10,000 grant, so this is all computational, but if you did get that $10,000 grant from EIDL, it'll automatically come out, but not until after you've done all these other issues. So I'm going to leave that and go back to my presentation and wrap up, and then we'll get on to questions because I'm sure you got them. So there's several unresolved issues. I still can't confirm that rent on equipment is included. I'm still waiting for clarification. I did get other non-real estate lease cleared up, but not on rent on equipment. So just know that's a little iffy. We also are not clear on the other debt, whether that includes interest on credit cards or other types of financing generating interest expense. It was designed for mortgage. What I did hear is that if you have any of your real estate as collateral to a business loan, like a line of credit, so it's collateralized by your real estate holdings, but it's not really mortgage interest because you didn't go out and get a traditional mortgage loan on it, it still qualifies. It's unclear as to whether the 630 cutoff is for use of proceeds or availability of forgiveness. So it could be because the second round of PPP extends beyond June 30th because your 8-week period, let's just say you get a loan approval next week and then you get funding 10 days after that, that's going to fall after 630. Nobody seems to know, do you cut it off at 630 like the law says, or do you get an extension? We don't know. It's also unclear as to what order to apply the 3 bases for imposing reduction forgiveness. I went through the logic on that spreadsheet based on several readings of the law, but they could reprioritize that. So you just should be aware of that as an unresolved issue. It's unclear for the computation reduction, reducing compensation for the 8-week period by more than 25%. If you paid it to any one employee of the preceding quarter, or whether you can accumulate and put everybody in the same pool. So in other words, if you don't do it on an employee by employee basis, and you in fact did reduce somebody, but then everybody else was kept the same, if you average out compensation, then you don't run the risk. But if you do it on an employee by employee basis, then you are less than 25%. We don't know which one to apply. Obviously apply the one that's most advantageous to you. And then if you get corrected, you'll know why. Very briefly on EIDL, it has funded, but for whatever reason, they have not started anything. It's frozen up, and nobody seems to know why. When I check it daily because I have an EIDL application pending, it tells me now that I have to resubmit my affidavit. I go to the website URL that they tell me to go do that, and it tells me we're not doing anything now until we ferret it out. So it's effectively frozen up. Every day, you check it and see what's happening. They are now allegedly starting to accept $10,000 disaster grants again. I haven't gone in and tried it because I already got mine. But Aaron was just telling me this morning before we started up the seminar that, in fact, you can't even get your $10,000 grant out of the deal. So it's the government. I know they're working at it. There is an amazing array of responses folks have gotten from the SBA. One outfitter already got his full loan amount, but he never filled out the larger application. So it was calculated as $180,000. He got $180,000 put into his account, and he can't figure out how they figured that amount out because he didn't actually ever put in a loan amount. It's my understanding what they do is a calculation based on your financial statements, and they're either doing 2 times working capital or something of that nature. So they just kind of randomly decide how much money they're going to give you, and that's what you get. And it also seems like there's several places you could be in the queue depending on when you applied. So pre-April 3rd, some people got to the big applications. From April 3rd on, you were relegated to only going into the disaster loan grant for 10 grand, and you've never filled out the bigger application. And the URLs are really confusing. These are the ones that I found. disaster.sba.gov.ela. If you did a long form, then you're given another place to log in. And my guess is people on this call have probably even got more ones. So what tools are available to you? This new spreadsheet forgiveness on forgiveness is the SBA and Treasury guidance, both on the self-employment calculation. We had a lot of complaints relative to, hey, you know, I'm self-employed, I have a pass-through entity, I can't really count myself because I'm not on payroll, what do I do? Well, now this guidance is very specific as to how you get to fill out the application, as well as this new seasonal business. This presentation will be available to you. So check the AO site often, and you're always free to email me. We'll probably wind up doing the same thing if we don't get through everybody's questions. I'll go ahead, Hillary will download it into an Excel spreadsheet. I'll answer all the questions as best I can, and we'll get that posted as quickly as we can. Now, I did have one new money-making idea for you guys because I know some of you are lacking sources of income. Cryptocurrency is the hottest ticket, so you might want to consider investing in a new type of cryptocurrency. It's called Buttcoin, and it could be really effective for your business. So you got to lighten it up a little bit, don't we? So with that, Hillary, why don't we take questions? My email's sitting there, so you guys can ask anytime you want. Go for it.
All right, so we do have lots of questions. I started trying to organize them by type, but it's getting away from me, but we'll start out that way. So Ashley wanted to kind of share that she was able to go back to the bank, paid back the original PPP loan, submitted a new app, and for the larger loan based on the new seasonal calculation, they were approved and funded for the new amount this morning.
That is awesome.
That's great. Now Taylor wanted kind of along the same lines. We received a PPP loan based on our trailing 12-month average. Largest payroll is in September and October. With the new rule, could we resubmit based on September, October? And what your advice is for that?
So, like I said, you absolutely can do that, but what it requires is a clawback. So your lender will, and if you've already started spending funds out of that PPP account, I think the answer is no. If it's still sitting there unspent, then what the lender will do is it'll claw it back, pay it off, resubmit a brand new loan, just like we heard from Ashley. It'll be under the new loan request numbers based on the new calculation, and it'll get resubmitted. But now here's the tricky deal. Here we are on Thursday the 30th. I've heard all sorts of different rumors with regards to when we're going to run out of funds. Depending on how fast your lender is and whether they can do it. Sound like Ashley's got a dynamite lender. But if your lender is a little slow at the draw, and you're in a big massive queue. I mean, I've heard of some lenders, they got literally 1,000 applications on file right now. It's first come, first serve. So the risk you play is if you give back your money now and then don't get in, you're done and you didn't get to participate at all. So you have to really evaluate. What I would encourage you to do is just find out exactly how much more you can get. I have a good friend that put in for an amount, and because of seasonality, their loan was like 10 grand. And that falls under the category of who cares, especially if they have an idle for 10 grand, because then you get 10 grand, but you have to pay back the 10 grand because it's applied to triple P. So what did you really accomplish there? A $10,000 loan at 1%. So for that person, it might make all the sense in the world if they have a substantively larger set of payroll for a couple months. So Taylor, I'm sorry, I'm not being very advisory oriented here because it's a crapshoot, and I'd hate to say go for it and then you lose out. It's a risk decision that you and your lender are going to have to. I would talk openly about what is the probability that they think you can get through and how quickly.
I might add to that, Pat, a little bit, as I've been following the outrolling of this rule, and we heard from at least one outfitter, I think a couple outfitters, as they were trying to find the right link from our newsletter the other day, who were talking to banks who were unaware of this new rule around seasonality, and were trying to point them to that. So we eventually got the right link out. But I wonder if I could like briefly try to screen share, Hillary, and see if I could show where this is, because it's 2 quick links away, and that might be worth it. And if somebody wants to point it out to their bank, right?
Are you ready?
Yeah. Okay, great. So are you guys seeing this interim final rule? Wait, oh, I have to show my.
You have to accept it.
Yeah. So this is what, do you see this Department of Treasury document?
Yes.
Yep.
Okay. So this is the rule. While we're looking, I won't read this to everybody, but I do want to point out this, Pat, that seems to me to be a potential hiccup, right? The rule is dependent on, its effective date is dependent upon its insertion in the Federal Register. And I've been looking for that every day. And here is today's, and due to a technical issue, they're not like today up yet. So we'll keep looking for it. But if people can find it on the Treasury Department page, and you just go to treasury.gov and go straight to the little red COVID line, it is on that page. And just scroll down until you find, I believe it's under program rules. Yeah, this interim final rule on additional criterion for seasonal employers, and it will take you to that same rule. Okay, so I'll just point that out. And while I've got the screen, I just wanted to direct people to, oh, my thing covers it up, 1 second. Yeah, our COVID-19 page, where we're keeping a lot of your stuff, Pat, and where this new stuff will show up too. So right on top of the COVID-19 is the financial aid and loan information. A few Swan Mountain Consulting things in here already. So thanks for your contribution already, basically. And yeah, I'll leave it with that. I don't have anything more to really share from my screen, but happy to hand it back over to the questions now.
Awesome, thanks. I will go back to Pat then, if we want, so that we can see your email. All right, next kind of area is the wage balance issue. So Matt asked, is the employer required to pay the employee at least 75% of the total amount the employee was paid during the previous quarter? So if the employee was paid a total of $10K in wages during that quarter, would the employer be required to pay at least $7,500 over the course of the 8-week loan period? Or do you know how that breaks down as far as like total versus direct connection to their wage amount or hour amount?
Hillary, I'm sorry, I didn't understand the first part of it, so just ask it one more time. I apologize. I was fiddle-faddling with my screen like a lame-o.
Sure. Is the employer required to pay the employee at least 75% of the total amount the employee was paid during the previous quarter? So if it was
So the
10K.
quick answer to that is yes. So what happens is if you are more than if you have reduced their wage during the 8-week period by more than 25%, the dollar for dollar amount that you underpaid the employee will go against your forgiveness calculation. So let's just say employee A made a total of $25,000 wages in last quarter. During this period, you only paid him 15 grand. That's a pretty material drop. It's more than 25%. So you're going to have to take the difference between what you paid him and what you didn't pay him, and that becomes a dollar for dollar reduction of your forgiveness. Now, the thing that I want to point out is that's on an employee by employee basis. But if you have 15 employees and you only did this to one employee and the rest of them are held true, if you calculated the same wage to wage comparison quarter to 8-week period and it doesn't result in 25% reduction from gross payroll to gross payroll, I would try with that calculation first, because some people are interpreting that it's measured on an employee by employee basis. Other people are interpreting it is that it's on gross payroll to gross payroll. So do the one that works the best for you for now, submit it. But if there's a way you can also manipulate other things during this 8-week period by maybe generating more payroll or something else so that you far then exceed it, then maybe that's the way to get it done. That's the whole purpose of working on this now, is you got a lot of time to plan how you make payments. There literally is nothing that precludes you from accelerating payments to people so that it falls in the 8-week period. So you could theoretically prepay people who are for an entire pay period just so that it falls into the 8-week period. You could do that. I just want to caution you, though, there's a very magic number to remember. You guys all need to write this down. $15,384.62. That is the maximum amount that you can pay anybody in your 8-week period. Why? Because that is based on the $100,000 cap. So recall that the PPP originally said that you cannot claim any wages in excess of 100 grand. So if you take 100 grand and divide it by 52 weeks, you get an amount. If you times that by 8 weeks, you get $15,384.62. So if some of you are going to be fairly aggressive in paying your owners, which is great, I advocate for that. There's nothing against the law doing that. You can do big bulk payments in that. Just understand that if you pay in excess of 15,000, you are now violating the rule, because you're not allowed to exceed the equivalent of 100K in a year. Hopefully that made sense.
Yeah.
There were a lot of questions related to that with like strategy for owner pay.
There's one other thing, Hillary, since we're talking about strategy, that I want to point out, because I even thought about it myself. So I have a granddaughter. She's about the most special thing in the world, and she loves our llamas, and she actually is a llama guide, an assistant llama guide, but she's only 12. And I had actually thought about putting her on payroll to give her a big hunk of money if I was concerned about whether I would get to my 75% or not. But just remember, any real clever move you make, it has to make financial sense. In the state of Montana, based on all the taxes and everything we pay, our payroll burden is 23% for every $1,000 of wages paid. That's $230. So does it make sense to spend $1,230 to get forgiveness? So you're out that $230 per $1,000 of wage. Does that just make sense to you to save on a forgiveness when all you're looking at is a 1% loan? So it has to make economic sense. I don't want you to be so driven by forgiveness that you make kind of lame decisions relative to what's just good finance. So I was even guilty of it. I was thinking, yeah, I'll activate all members of the family. I'm going to get to 75% come hell or high water. And then I realized, wait a minute, I'm just going to be out of pocket all these expenses. And so why would I do that?
All right, a couple more on wage balance. Nicholas is curious if there's a distinction between like reducing hours versus reducing hourly wage when you're looking at that 75%.
So the 75% is just going to be a dollar amount. So you have to reach the threshold of 75% of your triple P proceeds. But Nicholas, you bring up a really good point relative to hours versus pay. So there's two different measures. If a person's hours get dropped to the point where they're no longer an FTE, so under 30 hours per week, then that messes with your FTE calculation. If you drop their compensation by more than 25% of the previous quarters, then you're messing with the 25% computation. So they have kind of two measures here that they're trying to zap you on. Either your FTE count or your reduced wages thing. So they're both thresholds you have to pass.
That's great. You know, and I should point out too, I think this is pretty crystal clear to everybody who's been following your presentation that though the seasonality of the loan calculation was changed, the seasonality of the 8-week loan period is not. So that still wraps up in June 30th. So if people want to try, you know, paying in advance and some of those strategies, they of course run some risk, but that hasn't changed. We are working a little bit. We are working with some groups on some legislation that might address that. So there is some hope there. And I think the guidance I would give around that right now would be to not hold out because as you started this conversation off with, Pat, there probably won't be more money, right? So more of a
I think
strategy.
triple P is dead. You know, I feel as if this is your last drink at this well, and then they may or may not come up with other types of assistance programs.
Right. So.
All right, let's keep going. Okay, Jack Rich asked, non-employee compensation was allowed when we applied. Does your form provide a space for these numbers?
No, so the way you build up your calculation was solely for purposes of getting a highest loan balance you can. By the way, how you doing, Jack? I love Jack Rich. So you just almost set the computation of the loan amount balance aside, because now when you're looking at forgiveness, only these things qualify. One of the glitchy things that happened, if you were one of those fortunate few that took the early advice of including your independent contractor amounts, because under the law it stated you absolutely could. And so I know on my loan, I submitted $99,000 worth of independent contractor cost, and it got approved by the SBA and by my bank. But now, since then, there's been very specific guidance that have come out. If you're applying for a triple P today, you absolutely cannot include independent contractor expenditures as part of your application. Regardless of whatever you did on the getting your loan, the measurements are quite clear. So under the wages, Jack, you get to include obviously your wages, and you get back to this estimate of tips. It says right on there that you can include tips as part of the buildup of what you're earning. Now, I find that very confusing. So what does that mean? Do you estimate that a bunch of money's coming in the form of tips and you put that in so you can get forgiveness? I mean, that seems a little outrageous to me, that you could do that, but nothing says you can't do that. But where would you write your check? You know, so if you're using these proceeds specifically for the uses intended, And so under payroll expense, I again put it under quotes, tips was part of your calculation to ultimately get to your full loan balance. And now you're turning around trying to figure out how you can spend money in such a fashion that you get it all forgiven. What do you write people checks for tips that are going to come? I'm confused by that. I don't think it can happen. So I think, Jack, you're precluded from just doing the traditional computations of wages and focusing on trying to accelerate wages. If you have trusted people that you know that won't walk on you. So we have a manager core in our group, and we typically only pay, well, we pay twice a month, on the 5th and on the 20th. What we're going to do on our June 1st to June 15th payroll is we're going to pay our managers for the entire month. Nothing says we can't do this. I have vetted this with so many CPAs, and every one of them said, absolutely, do it. Now, what's the risk you run? Well, the people quit at the end of the 2-week period, and you've paid them for 2 weeks of work that you're not going to collect. Well, obviously, you need to select the right kind of people that you'll do this with, because you're effectively prepaying them for an entire month's worth of work. I'm using the 15th as a cutoff in June because that's when my 8 weeks expires. So you would do the same thing. Wherever your 8 weeks expires, that last stub pay period, you got to make sure you try to throw as much in there as you possibly can. But I want to caution everybody right now, you know, Montana isn't up in arms here with regards to what we really get to do and don't get to do. And so just bringing on people and incurring large amounts of payroll and then using the proceeds from PPP to go out and pay that payroll, but you really don't have anything for them to do because you're technically not open yet. That's just not good finance, and I can't recommend that. Hopefully that answers your question, Jack. I'm sure I'll get a call from him. We usually kibitz on stuff like this.
All right, just going back to the wage balance, I think that maybe the way I asked a question confused some people. So I'm going to read Scott's comment here. So he's confused about the 75% individual payroll requirement. He said, so over 8 weeks, we have to pay 75% of what someone would have made over 12 weeks. I think that's where I confused.
No, you nailed it, Scott. You nailed it.
Oh, that
So
is right.
that is right. So
you have to give
this
them
is
a
one of
raise.
the many just bizarre elements of what's happening here. You essentially have to spend in 8 weeks 75% of your loan balance under wages. Now, this is just for forgiveness. You don't have to do this if you don't want forgiveness. But if you're trying to get to 100% forgiveness, then you have to somehow or another spend 75% of your loan balance. And if you got that balance way high because you averaged out, or now the seasonal people will get it really high. Imagine a guy that's in fall and he resubmits his application and his wages are really high because let's say he's a fall hunting operation. And now he's in the measurement period for 8 weeks. There's no way he's going to have that amount of payroll in an 8-week period in June when he's a fall operator. And so what's going to happen to that person? He's not going to get forgiveness, but he is going to get a 1% loan. So Scott, that's very bright of you to pick up on that. That's one of the incredible inconsistencies of the law. You're basically comparing a quarter to an 8-week period, which is 2/3 of a quarter, which is lame. But there's a lot of lame things about this law. But at the end of the day, if you want forgiveness, 75% of your loan proceeds have to be spent on payroll stuff. That's why we're advocating so strongly to prepay things that you ordinarily wouldn't pay this time of year. I mean, we make our retirement contributions on December 28th. And this year we're going to do it on June 1st. Why? Because it qualifies for forgiveness. It's the only reason why.
Several people are asking questions similar to Ari's here. Can you give an amount back after the 8 weeks that is unused in the PPP to get to that 75% for forgiveness? Or, just what do you do with money at the end?
So if for some reason you don't use all your triple proceeds or you don't qualify for forgiveness, so in other words, the only reason you did this was because you were looking at an opportunity to get a grant, because a triple P loan converted to forgiveness is effectually a grant. It's a non-taxable grant. And that's why we advocated, as the association, everyone's, why would you not apply for this? Who turns down grant money? But let's just say you don't need the money necessarily as a loan, that a 1% loan is not really of interest to you. You have no debt at all, then just turn it back. And if you turn it back within that 6-month period, the amount of interest that you're going to be charged on whatever balance is going to be minuscule at best. And so if those of you that do not have a need for the cash and do not want to carry a 1% loan, once you've got done with your forgiveness calculation, then turn the rest of it back over if you don't want to incur a 1% interest loan. I think there's a lot of people out there, though, that have a lot more expensive debt than 1% loan. And so once you've gone through the forgiveness calculation, you now have just a loan on the books. And if you could use that money for other aspects of your operation, you essentially can, because it is still covering payroll and other things just outside the 8-week period.
So you kind of talked about doing your doing some things in July, or sorry, June. Someone asked, can you prepay healthcare through the year, and can you prepay rent through the year during this time period?
So you can prepay anything. There's nothing that says you can't, because this is based on cash basis. Prepaying healthcare premiums for more than maybe a couple of months, you'd have to scratch your head and say, is that wise? It depends on who your plan is covering, whether those employees, if you're paying an employer portion to that on behalf of employees, because you run the same risk of prepaying employees way in advance. If they wind up quitting, you're out that money. And so you have to weigh the good finance decisions based on whether you're just trying to get for forgiveness. The one thing I'll tell you about prepaying rent, and this is very important, especially for you folks that have a lot of related party rent. So I know you've heard me in lots of seminars advocate for separating your real estate from your operations, so that if anything happens in your operations, it doesn't pull down your ownership and they can't get access to your real estate. So several of us have LLCs or different types of entities that own the real estate, and then we turn around and charge rent back to our operating entities, which is totally legitimate, totally legal, makes all the sense in the world. You could accelerate a payment to that related party entity, but here's the key: is you will ultimately have to make sure that it is in alignment with what you've done historically. So what probably won't work, and when I say probably won't work, we're all subject to audit on this. So depending on the size of your loan and just how aggressive you are, you could at any time be selected for audit. Now you're going to have to prove up. One of the things they anticipate will happen on leases is they're going to look, first of all, was the lease in existence prior to February 15th, 2020? If it was not, it doesn't qualify. The second thing they're going to ask is it in writing? So a lot of related party leases aren't in writing. So you're going to need to get a document in your files that basically memorializes the relationship of your related party lessee lessor. And the last thing they'll probably look at is if year in, year out, you've been, maybe charging this entity 50 grand in rent, and this year, just for purposes of achieving a triple P objective, you charged it 75. That will look a little stinky to an auditor. They'll say, wait a minute, why all of a sudden the jump in rent? And if your answer is, oh, because I just wanted to get forgiveness, that dog won't hunt. I think you understand that. So it has to stay consistent with prior years. But the timing of the payment, so by way of example, one of our facilities we rent for my daughter, and we usually make 2 payments, one in June and one in December. We're just making the entire payment in June, but we're keeping the exact same amount as we always have. We're not exceeding that amount.
All right. Okay, so Bobby asked, is there any clarification on non-real estate leases, such as state or federal permit fees as qualifying?
Yeah, that's a great question, Bobby. So for instance, I have a state of Montana special recreational use license, and we got a bill, we get an annual bill. It fell in the 8-week period, and it says right under it, state lease. But it's not really a state lease, it's a special recreational use license. And I could just see some dweeb auditor going, well, that's not a lease because, you know, that's a use license. So you need to look for terms and things that really resemble leases. And so what would that mean? There's a contract involved. It's multiple year. It was in existence prior to February 15th. What we're doing as a family and what I've been advocating for all the people that I've been working for is you just got to pass the straight face test. If things are legitimately leases, but they're for something non-real estate, they should qualify. Like our horse pasture absolutely qualifies. Why? We're under contract. We pay it monthly. We've been doing it for years. We have a, you know, so we are renting space to put our horses in the off season. That's what we do. Nobody's going to question the legitimacy of that. The one that I can't get an answer on, and everybody thinks that it qualifies, but they don't know because subject to potential future interpretation, is equipment leases. So a good example of that is some of you lease your fleets, your vehicle fleets, like your vans and stuff like that, and they're legitimate multi-year leases. I would say that based on the spirit of the law, those would qualify. But understand that that could get thrown out. And if it gets thrown out and then you dip below and you don't get forgiveness, you're done. So what I would do, what we did is we took all the things that we know are unquestionable. And on the 25%, we have so much more than what the 25% is in things that qualify just by our utilities and all the things that are just straightforward in our regular lease payments. It just wasn't a problem to get to the 25%. So, but if you are struggling in getting to the 25%, then you might have to try to figure out a way to get creative. And then at that point, I'd say, what do you got to lose? Because write it down. If they kick it back, it didn't work. Well, it wouldn't have worked anyway because you can't muster up anything else that qualifies for 25%, then fine. But don't replace something that's really legitimate, like, you know, power and light and gas and sewer and water and all those things, or leases on real estate, by something that's uber creative, only to get that denied, and then it will be too late for you to slot something else in its place.
That's great.
All right, lots of people are throwing out the idea of paying seasonal bonuses during the 8-week period, which you kind of covered. A couple people are asking if you are paid as an employee of a few different businesses, is that 15,300, etc. number the total that an employee can be paid, period?
So briefly on your first remark, Hillary, so the seasonal bonuses is a great idea if you think that you don't run the risk of people underperforming after they've received their bonus versus earning their bonus, but it is a creative way to work it. Just make sure that their regular salary plus their bonus doesn't exceed $15,384.62. On the second question, where you have multiple entities, it gets back to this issue of controlled group and affiliated entities. You were probably asked in your PPP process to identify if there are affiliated entities. this particular individual sounds like they have a number of different entities and enterprises going on. If one entity applied for and got a triple P and it's just straightforward, that should be just fine, that they're getting pay from other entities that aren't included in the triple P computation. But if you are subject to a bigger, broader look of consolidated entities, or if your banker is paying close attention to what's happening in other entities and looking at it from a consolidated basis, be careful. So that person might have to reach out to me directly. I might have to know more facts about that to give a better answer. But the short and sweet answer is if you identified affiliated entities in your triple P application, the reason you did that and the reason they want you to do that is they are very concerned about you double, triple, quadruple dipping by having all these other entities all apply. And I have a very good friend who has multiple entities, and he put in applications for all the entities and they all got triple P. And I said, wow, man, I just kind of feel like you're going to be in trouble because he's 100% owner of each of those entities and they do business with each other. And I'm a little concerned for him in that regard because that wasn't really what they had in mind. So have that person just reach out to me, Hillary, and if that did not answer their question adequately.
Great, thanks. Marlo asks, and Aaron, this might be a question for you. Are you aware of any lobbying efforts to change the law to let employers pick when the 8-week period is that they are able to use that money to pay employees?
Yeah, indeed. I've been working with a couple of groups just this week, almost as soon as the new rule came out of the Treasury, or I think it was this week. And we were working on some language that we feel we have some support from somebody to at least introduce around this. Our partners in this are American Mountain Guides Association and the Outdoor Recreation Roundtable. So we have some good pull there on the idea. And my concern is, as we mentioned earlier, that there might not be enough money left for it to make a difference at that point. But like now, I think there will be an opportunity to reapply if you have a situation that works better for you, if we're actually able to get that across the finish line.
So Aaron, oh, I'm sorry, I thought you're done.
Go ahead.
No, I was just going to say, so I think it's less about whether there'll be a new round of triple P, where I think the greatest opportunity on this suggestion and what you've already done with those other groups is let's go to Treasury and forget about legislation. There isn't going to be more triple P legislation, but what we can do is essentially what got accomplished when we did the definition of seasonal. We can go to Treasury and get a different interpretation, and that can come out in future guidance. And because we know the second round of triple P is going to go over the 630 anyway, it really, really would be helpful if the measurement period, and I think our biggest argument in favor of why this is fair and just and appropriate for Treasury to make the concession is so many of us are in states where the land agencies are holding us up. We can't go back to work even if we wanted to. And so we have this arbitrary 8-week period that just seemed to fall because they thought everybody would be back to work by now. Well, we can't go back to work. So I guess what I'd do is two things. Let's do the same thing we did when we reached out and ultimately got the Treasury guidance on the seasonal definition. We can work through Dane's office or all your different contacts as well. But let's see if we can get that concession done through Treasury, because boy, that would be really helpful to so many people out there right now. You know, I have to sit here and scratch my head whether it makes sense that we're going to bring a bunch of people on. And what are they going to do if I can't put them on horses and go out, if I can't go on trails? I mean, we have a situation right now where we can't even go out and clear our trails. We're precluded from stepping foot on public land. Well, now why would I put people on payroll if I'm not going to be able to do anything? You know,
no better time to do trail stewardship than now. You know, there's nobody to worry about. Yeah, I think that's a good thought. I think, you know, who knows like exactly how much any one component of our push for that seasonality had to make a difference, but it's a 1-2 punch, right? You sort of like you go for the language, you go for the legislation, you find people who will support it, and if you don't get the legislation, you've got the senators who are going to call the Treasury, like Senator Daines.
Yep.
Put in a call to Secretary Mnuchin, and I just have to think a few of those calls made a difference. And if
Sure
our
did.
next action will probably be not only asking for a little bit more, but a big round of thanks too, because yeah, this makes a big difference, and something like that would be huge too.
Yeah.
So
I want to mention to everybody on the call, I assume, Hillary, we're okay with this, but we'll do the same thing we did last time. I've cleared my entire morning for this. It's morning where I'm at. I know it's afternoon where you guys are at. But we'll go as long as Hillary says we can go. I'm in it for the long run. So we still have, gosh, yeah, we probably still have about 95% of the attendees hanging in there, which we appreciate. So let's just keep rolling until you guys say no.
what's your schedule look like, Hillary?
I think that we could be good to go till 4.
Yeah,
But
that's
that-
what I would do, Pat. Another 45 minutes, and then I'll probably have to shift gears.
Okay.
All right.
Fire away.
So go back up to the top here. Josh has a couple questions here. Because we included our seasonal employees as part of our original calculation, we have a surplus of money if we only bring back our FTEs. Can we use that extra amount to either pay advance payments, seasonal staff, severance if we can't operate, give existing FTEs a raise, or severance if we have to lay them off? And then he also asks, can the 25% non-payroll portion be used to pay interest on a pre-existing loan that an owner has made to the company?
So you can be as creative and as aggressive in the utilization of your 75% as you want. And if paying severance or paying bonuses or giving raises, as long as you don't exceed the 15,384.62 on an individual basis, you're going to be fine doing that. So, you know, that really makes sense for owners. A lot of the owners that might be on payroll, does it really matter whether you get your money ratably spread over 12 months, or could you just pay yourself for, you know, prepay yourself for 3 months? It's not like you're going anywhere. So there's a lot of creative things where you can use the cash basis of measurement, which is what this is based on, to try to get as close to that 75% as possible. But I will again bring up what I think is the common sense rationale of, don't let the forgiveness tail, you know, wag the financial business sensible dog. So if it just doesn't make business sense, like in my example of putting my granddaughter on payroll, only to incur a bunch of payroll expenses out of my pocket, what am I accomplishing there? Because I'd need to get her to give the money back to the company so the company could use the money. So she's just being used as a pawn in this scenario. That's when it stops making sense, is when you get so creative that you're, and the only reason you're doing it is for forgiveness purpose. I want to go back to the fact that, show me where anybody's offering a 1% loan. And I kind of feel like, based on the way things are going right now, some of you are going to need that money because you're going to have hiccups and delayed starts. And we also haven't even talked about what's the impact to our overall volume. I think I mentioned on the previous call that we got all the significant business partners in the Glacier area together on one call, and I had asked each and every one of them to go through what they anticipated was going to be their revenue, year-on-year revenue drop, and the average was 50%. So let's just assume you get to start full-fledged, everything's good, you're ready to go, you got all your employees back. You're still looking at 50% less revenue, likely, than you were from last year. So you're going to still have to think about cutting back your staff and other expenses, and you're going to need some form of funding. And a 1% loan is a wonderful value. So I hope that answered the question. It was two parts, right? Wasn't it? What, Hillary, what was the second one again? Remind me.
Yeah, the second part was kind of like a different, so can the 25% non-payroll portion be used to pay
Yeah.
interest on a pre-existing loan?
Yes. So if there's a loan, if it's in writing, if it existed February 5th, prior to February 15th, it's a legitimate financial instrument, then you can absolutely include that interest as part of the 25% workup. And I am telling people that credit card interest does qualify, but the best thing you could do would be, so what we did is we have a separate account set up at the bank. The minute we got the loan, we set up a new account, and it's Swan Mountain PPP account. And on there, the checks that we write, and we're going the old-fashioned route, we're asking for return checks. We want the physical return check given back to us, no images. We want return checks. And on the faceplate of every single check, we are being very explicit. So whenever you do related party transactions, make sure you generate an invoice. So in his example of where he's charging interest, have the other entity or the owner write up an official invoice that says interest owed on this loan per contract for this date frame and everything else. Very official document. Then on the faceplate of the check, it will say interest paid on loan number 355, for our business loan. So you, in the case of credit cards, you would write a payment to the credit card company for the interest portion only. So on the face of it, you'd put, MasterCard ABC, and then under the description, payment for interest owed on this credit card for the period of blah, blah to blah, blah. That's the way you can stay real safe and not get it kicked out in audit.
Yeah, there are a lot of people that are asking about that earlier piece that Josh brought up, which is that they reported the total number of employees, including seasonal, and they're only planning to bring back the FTEs. On your worksheet that you have, is there a place that kind of addresses that can help them with their calculation?
Well, let's see. So it all comes back down to this number right here. So the real question gets down to, what did you originally put on the faceplate of your PPP application? And there's a lot of mistakes that were made in that. I made a mistake. I really did. I thought that what you did is you took the high number count off the face of the 941 for any one for the quarter. So when I originally submitted my PPP application, I had a higher number in there. And then what happened was I realized that, and I thought, wait a minute, I want to put as low of a number in that application as I possibly can. So I went back to my banker. Now, interestingly enough, check with your bankers on this. All the paperwork associated with my original application, none of the paperwork is submitted to SBA. It's all resident in your bank. So what my banker told me is, he said, Pat, go back and change the faceplate of that first page of the PPP application to the number that you know is correct. Because what I told him is, I said, based on Treasury guidance, I calculated it wrong because there was no guidance at the time. So I was wrong, and I need to change that number because it's going to have a profound impact on my forgiveness. And he says, I'll tell you what, we don't submit the entire package until later. So everything they're going through is electronic, it's numbers. The SBA has put a tremendous amount of trust into the banks to do the right thing. So this banker And I want to emphasize that it was this banker, not every banker, but this banker said, go back and change it because you are correct. That's the way it should be. And I will accept that change. Your loan has already been approved and funded, but I want you to go back and revise that because you're going to be unnecessarily penalized by the number you put in there. So that would be one potential cure to it. The only other way you can do it then is messing with this thing, and you get to have the lower of the two counts. So maybe the solution is, as long as your FTEs that you're counting in the 8-week period is higher than either the number of people you had from February 1st to February 29th. So for most seasonal operators, I suspect that that's a really low number. Like most people just keep on their reservation staff and maybe their owners. So maybe that number's 4. So if you put 4 in there, it's going to take the 4. My guess is this is the number that looks really similar to what Josh and other people put in there on their application. And you just have to exceed the lower of one of these two numbers. So this is where this template is really, really helpful. Because if in your first quarter, it's not even really a full first quarter, for your first 2 months of January of 2020, if you had a really minimal number of people on there, depending on what kind of seasonal operator you are, surely you could get over the head count of that, but maybe not. And you might be Josh, you might have a unique business where your seasonality, the way it lines up with the measurement period and triple P and all that, and the 8 weeks, it just isn't a fit. And we were able to accomplish one goal, which was to get the way seasonal things were calculated done. But now maybe we got to go and try something different. I don't know. Sorry, my gardener's weed eating. I don't know if you guys could hear the weed eater.
We can't hear it at all.
Nope. All right. Kind of going back to earlier, way back to the start. Andrew asks for the 75-25, 75% for payroll, 25 the other things. If those thresholds aren't met, does that mean that nothing will be forgiven, or is it does it start eating away at your amount that's forgiveness if you don't meet that first?
Great
piece?
question, and that's what this spreadsheet does. So let's just show you what happens. So let's just say if you don't wind up using your proceeds, just put 130 here. You get reimbursed whatever you spend. If you don't spend it all, then it's just converted to a loan. So whatever you qualify, so in this case, if this person was entitled to the 290,000, but when it's all said and done, they didn't make that entire amount, then all that's going to happen to them is the difference between what they spent and what they didn't spend in the qualified areas just converts over to a 1% loan. And like the person asked fairly early on in the questions, you could always just give that back. If you have no need for the proceeds because you have no debt, because that would be the only reason that I could think you'd give it back, is you have no debt and you don't want any debt, not even 1% debt. And I'd still question that because you don't have to pay this back for 2 years, and they're not even going to start accruing interest for 6 months. So that money could just sit in an account, and you could use it as a rainy day fund in case things go from bad to worse. But the quick and dirty answer to that question is you get to spend it. You can spend as much of it as you can, and whatever you don't spend just becomes a 1% loan in either category. This template is designed, though, to show the interrelationship if you overspend, because I have yet to meet somebody that's concerned about underspending, other than whether they can make it in this wages area.
Let's see. There's also a question that I can't find right now that kind of goes back to that thing Scott was asking about with the 12 weeks amount needing to be spent in an 8-week time period. And somebody said, wait a second, isn't my 8 weeks being compared to the 8 weeks that I had to choose in 2020 as opposed to a previous quarter or the 12 weeks?
So your 8 weeks just comes up with a total, and you get to control that total. So like you see up here, this 156, which is the most variable of all, is the sum of all your pay periods that fall where you pay. So I'm actually going, ordinarily you'd only have typically 4 2-week pay periods fall in an 8-week period, right? But if it's based on a cash basis, you could have 5 because you paid in the 8-week period. So you effectively are accelerating what looks like an 8-week period, but you're extending it by making payments early in the pay period. Does that make sense? In the 8-week period. So
catch both the beginning and the end of it, almost try to work an extra pay period into it.
exactly. And you do that based on cash basis. So you could pick up the one that fell where most of the payroll was incurred prior to your funding date, but the actual liability was paid during the 8-week period. So you get to count it as if the whole thing was incurred in the 8-week period. That's the goofy aspect of the law. And same thing with your last pay period. Even if you run the risk of having to pay that last pay period outside the 8-week period, pay it prior to the expiration of that so you can maximize the amount that's paid in here. And you just have to work with your payroll provider to do that. So this 12-week versus 3-month look, it just gets down to how much can you spend in the 8 weeks. And you're absolutely correct, because up here, everything was calculated based on, I happen to use the 12-month average here. But whatever way you got to this, you came up with a total. You almost forget about this now. It's irrelevant at this stage. All we really care about is this part here. How do we spend it meaningfully, not stupidly, but meaningfully in order to maximize forgiveness? But Scott and then others have pointed out a fundamental flaw in the law. There's no question that 8 weeks versus 12 weeks is a fundamental flaw.
Are you able to use the loan forgiveness to pay for membership association renewals, Pat?
For this call only, absolutely. Call it interest in the best interest of the industry.
Yeah, we're just working on our membership appeal. It's an interesting time to ask the question.
Well, and for all the value that AO's added in terms of the influence up, in Washington and getting these treasury things and hosting these webinars, how could you not support AO at this point? They've got your back every step of the way.
Yeah, well, there's so many folks like you who have just, like you said, stopped the meter and just made yourselves available, and it's making a big difference to everybody. So we're just channeling all the great people who have so much good information and all the good information out there. But thanks.
Yeah, you bet. What else we got, Hillary? Try to squeeze as many as we can.
All right, Carla asked, and I can't remember if you said this exactly, so I'm going to ask. On your dedicated checking account, are you still paying employees with direct deposit, or are you using paper checks?
He's going to show us the check.
Sorry, I
Yeah.
had to close my window because of the weed eating. It always happens that they weed eat right in the middle of webinars. So direct deposit is fine, but save the payment advices, the ACHs. So you have effectively what is the equivalency of a canceled check in the form of an ACH summary or payment advice. So for those of you that utilize payroll processors, they usually give back to you a full file that has your payment advices, your payroll summary. On a quarterly basis, you'll have your 941s. Every piece of that will constitute documentation that needs to be present when you're going through the process and looking at what potential auditors or the bank will want to look at as proof. But you don't need to physically use checks for payroll. Just have really good documentation anytime you ACH or auto pay anything out of that account, because you're going to need to provide some kind of proof other than just a line entry. But even on a line entry, like I read in advice yesterday, where let's just say you do an ACH, and so you look at the statement from your PPP checking account and it says payment for rent, and it was auto paid, so it went out via ACH. There's no physical check. You'd highlight that in yellow, and then you'd have some documentation, either an invoice or something that backs up why that amount left that PPP account, and that will suffice.
All right. Once again, can't find them right now, but we talked about this a little bit last time, but we're having some more questions around just the piece of if certain employees can't work during this 8-week period, what about finding a different person that can kind of be that equivalent employee?
Yeah, so that's a great question. They're not doing specific tracing on any individual employee, so they're not looking to see if you brought back Jim, Harry, and George. They don't care. They look at 3 versus 3. So if you had 3 employees and now you have 3 employees, if it's 3 different employees, they don't care. It's about headcount. It's about FTE. It's not about names. So the people that you hire back, or the numbers that you get to during this 8-week period, can be constituted of any other people you want. That's why a lot of people have thought long and hard about, well, we'll just hire our family members back. Isn't that a great idea? And the answer is, well, yeah, it's a great idea if they're already on payroll and all you're doing is prepaying them. But it's a terrible idea if they're really actually not doing anything and you're incurring a 23% payroll burden for every $1,000 you spend on them. Because now you're just paying money to the government for payroll taxes, and you achieve nothing because you have to pay $1,000 in order to get $770 of cash. Well, that's kind of dumb. You know, you'd be better off either just turning the money back or accepting a 1% loan and doing something else with the money. To me, it just doesn't make sense to pay $1,000 to only get $770 net in cash. And I hope people understand the difference between that and, okay, I already always pay myself, I don't know, pick a number, 50 grand. So I'm going to pay myself that amount of money throughout the year anyway, but I'm going to accelerate payment now during the 8-week period. Remember, you can only accelerate it to the point of $15,384.62. So it's not any big whopping deal, but at a minimum, every owner and every trusted party in your little fiefdom, you could do that acceleration alone. And for a lot of people, based on the size of their loans, that might be just enough to get them there. And that, combined with a little creativity with your pay period manipulation and your payment of things, accelerating payments in the 8-week period that you can already incur anyway. That's really the caveat. I want to keep emphasizing you're already going to do it anyway. You're just doing it now to maximize forgiveness. Don't pay stuff that you wouldn't do otherwise, because that's silly. You're just out of pocket then. In particular with payroll, because there's an extra cost associated with everything you run through payroll. And it's your payroll burden, which I think across the country averages about 23% of whatever your gross wages are.
All right, just one more question here that came in, and then we'll wrap up and see if we can answer some questions for you all after the webinar. Donna kind of wants to get this clarified once and for all. She put down that she has 15 employees when she filled out the form. But she's only going to have 3 to 5 FTEs for the upcoming 8-week period. Should she try to change that?
So let's just, since we have the form right up here, so it sounds like, let's just say, too bad we don't have Donna on the phone because we could just step through this example. But in this case, what's going to happen is, let's just say both of these are 15. Either way you measure it, either back on June 15th through the 30th is 15. I feel as if 15 might have been on her application, but the way this thing works is you can measure the FTEs that were from January 1st to January 29th. And let's just assume we'll do it both ways. So right now, under what she's saying, if she only puts the 4 in here, watch how desperately she gets hammered on this thing. $212,000 a reduction. So she gets slammed. She's not going to get anything. But what I would say is, what's more likely to be the case is, let's just say that in fact she had 4 employees during that off time. Now she doesn't get a reduction. So make sure you understand what's happening here, because regardless of what's on the face of the triple P, this period here might be the salvation for everybody, unless you're a winter operator and it becomes higher than what you had in that June 15th to June 30th. But for us, that period of January 1st through January 29th was the lowest amount of employees we have in a year. You know, we ramp up, we're a multi-seasonal business, but our lowest employee count is in this period in the year. So I'm kind of thinking that Donna might be okay, not knowing her certain circumstances, but knowing that if she's only going to have, let's say, 5 or 6 people here, as long as she exceeds in this 8-week period the amount of employees she had on staff from January 1st to January 29th, she'll be okay. Now, if she had 15 people in that time frame, well, $174,000 of her loan balance will not be forgiven. And if she got idle, 10 grand, so now 184,000 of the $290,000 is not going to be forgiven. But I would say for 90% of the people on this call, this is the key number right here. Your number of FTEs from January 1st to February 29th of 2020. And I'm only saying that because the vast majority of us are primarily summer and fall operators. Yes, there are winter operators or just pure fall operators, but it's only the dog sledders and the snowmobilers that will really get probably screwed, the true winter operators. All the rest of you should be okay, depending on what your staff was from January 1st to February 29th. So once and for all, Donna, I don't know if I cleared it for you, but I'm hoping that helps you.
It's not intuitive, Pat, but I'll tell you what, this is a fantastic tool that you're making available to people, and crunching the numbers a little bit will answer a lot of these questions that otherwise folks basically like have you for. So
Yeah,
great.
well, we spent a ridiculous amount of time developing this, and my daughter's a kind of a spreadsheet wizard, so actually I put it together, and then she said, what were you thinking? And that she says that a lot to me. And I said, I don't know what I was thinking, but I can tell you what I wanted. And so between the two of us, we were able to get this thing to work. And I think it's a pretty decent tool. It's not a panacea, so I'm sure some of you out there have such unique circumstances that no spreadsheet in the world will be able to figure out what you're doing. But for the vast majority of folks, I think this could work pretty well for you.
That's really great. So I think that Hillary and I actually both have to jump, Pat. So
Yep.
Even though we were going to go until 2, I think we're going to have to wrap it up now, but it's been really great. And this really was prompted for the folks who are still with us, by your inquiries as they came to us, and as we either funneled them to Pat if we couldn't get to him, or as he took them directly, and we recognized that there was need for a follow-up. So Pat, I imagine you're in the same boat still, right? That if we're a few weeks down that road and we're still getting a lot of inquiries, we'll try to keep this series going.
Keep it alive. And we might wind up doing the next one on idle if that damn thing ever comes back to life. And we'll just keep whacking away at it until we get all of us through this nonsense. That's what we'll do.
Sounds great.
And for those who are asking the question box right now, we're going to get this up on the website very soon, right after this call. So that's the first step, is to actually try to plug your own stuff into the worksheet. And then, look at the Q&As if we get those up soon. And we're also going to get up Pat's presentation very soon. So all that'll be coming out. And then if you have more questions, let us know.
That sounds great. Thank you, Pat. Thank you, Hillary. Thanks to everyone for continuing to tune in to these, and I'm glad you're finding them helpful. And we'll see you all soon.
Bye-bye, everybody.